Hi, today we're going to show you our new options screener. So first we start on the front page, immediately go to the Start Analyzing button, and then go to Derivatives, which takes us down here. We'll go to the options screener. Now we don't really technically screen over options, we screen over volatility. So what we're saying is that certain characteristics of a stock are predictive of future volatility. So first, I'm going to talk you through some of the characteristics we're looking at. The first is value. Value is exactly the same as the value measure we use for deciding if a stock is cheap or not. It's based on the price to book ratio. Stocks that are high in value tend to have overpriced volatility. So in that case, we could sell options on value stocks and expect to make money. The next factor is size. Again, exactly the same as the size factor we use when we're analyzing stocks. Small cap stocks tend to have overpriced volatility. Idiosyncratic volatility is the volatility we get after we remove the stock's relationship to the overall stock market, essentially by taking out its beta component. Stocks with high idiosyncratic volatility tend to be overpriced in terms of volatility. The term structure slope is the difference between the 1 month implied volatility and the 6 month implied volatility. A stock whose 1 month volatility is a long way under the 6 month tends to be overpriced. This is because essentially the volatility will slide down the term structure curve towards whatever the front month is. Now, although we've done this in terms of the 6 month and 1 month option, it doesn't necessarily mean you need to sell either of those options. You can sell any option you like. If a stock option is overpriced at one tenor, it tends to almost always be overpriced at the other tenors. The implied volatility premium is the difference between the implied volatility and the previous realized volatility. We're doing this in a very robust way. We're comparing 1 month implied volatility to the realized volatility over the previous 100 days. But the measure is far more robust than that. This used to be very predictive. It's still predictive, but not what it used to be in the past. There used to be volatility hedge funds, maybe 10 years ago, who would make 40 or 50% a year doing this, purely screening on the implied volatility premium, using nothing else. Now, if you do that, you could probably expect to make about a quarter of that. As I say, it's still predictive, just not what it used to be. And this is important to note because there are a lot of option screeners out there that screen only by the implied volatility premium. And this would be like buying a stock purely based on its PE or its dividend ratio without looking at anything else. I mean, again, it's predictive, but it doesn't seem to be a very sensible way to approach the world when we have a lot of other things we could screen over. Absolute momentum is just that a stock is moving or it isn't moving. It doesn't matter whether it's moving up or down. So this is slightly different from the momentum number we use when we're calculating whether a stock is a good buy. This is saying at this end, the stock isn't moving much and options are a good sale. At this end, the stock's moving a lot and options are a good buy. So all of these 6 factors have been shown to be predictive by various pieces of academic research and also from the experience of option traders. So in this video, we've looked at the factors that predict volatility. This lets us determine whether options are expensive or cheap. In the next video, we're going to see specifically what we'd do once we've had that information. And both of these videos will be posted on YouTube at the same time.